So our speaker today, Karla Dennis, she's been seen in Forbes magazine, woohoo, very beautiful lady. She's an expert tax and business strategist. As an enrolled agent, she is licensed to represent taxpayers in all 50 states. She holds a master's in taxation and business development and is the author of 2 books, Tax Storm and Against All Odds, Against the Odds. That's the way it feels in the tax world, I know for me, so I'm sure some of you feel that way. She's CEO of the consultancy firm Karla Dennis and Associates and has saved your clients thousands of dollars. She has also been featured in various media outlets such as Forbes, MSNBC, KTLA, Yahoo Finance, and Smart Money, marking her as the ultimate tax expert. Please give a warm welcome to Karla Dennis.
Thank you so much. Good morning. Good morning. How is everybody? Thank you so much. Right. Are you guys ready to talk about taxes?
Yeah.
Really?
Yeah.
Well, I'm excited to talk about taxes. I am Karla Dennis. It is my pleasure to stand before you. And this morning, I have 3 things that I want you to walk out of the door with. And if I give you these 3 things, I will feel like I have done my job. Number 1, I want you to walk out of here knowing how these tax laws are going to affect you and some of the traps in the tax law. I want you to know how to properly apply the law, and I want you to be able to reduce your tax bill. Would that be okay? Yeah. Those are the 3 things that we're going to learn, and in order for you to get out of here, we will have an exam. All right. So, I am Karla Dennis. I do eat and sleep income taxes. This is my zen. I've been in the tax industry now for over 30 years. When I graduated college, I did not take your traditional role in a CPA firm. I went to work for a tax law firm that focused on reducing taxes for investors, business owners, people like you. I went back to school, received my master's in taxation. When I decided to be a mom 27 years ago, I opened up my own practice and I focused on tax reduction strategies for the normal individuals and tax preparation. So my background's a little bit different. I do eat and sleep the tax code. I do read the tax code for fun. And if you challenge me, I will be able to handle it. When they came with that new tax law, HR 1, I stayed up all night to download those 232 pages so that I could read it. And people are like, Karla, you're such a weirdo. I'm like, maybe I am, but I do enjoy taxes. But I don't do this alone. I have a team of misfits. We are located up in North Orange County, but I think we have one of the biggest tax brain trusts in the industry. My team is very knowledgeable, very well known, and I'm not going to say we know 100% of everything, but I'm willing to guess we know 99.9% of it, and that 0.1% we'll figure it out for you. Make sense? All right, and these people I love because I couldn't do my business if I didn't have them. So they're really good people. All right, so let's talk about these new tax law changes. How many of you are aware of the new tax law changes? Anybody willing to raise their hand? So what do we know about them so far? What have we heard? Anything? What?
They're going to pay more.
They eliminated some of the deductions. What else? They increased some of the deductions. Anybody else? Are we expecting to owe or reduce our tax bills?
Oh.
Who said owe? Let me see a show of hands who said they expect to owe more. Okay? And who expects to reduce their tax bills? And the rest of you don't plan to file? That wasn't an even Steven 50-50 split. All right, so most of these new tax laws, the tax law change came effective 12/31/17, but for all intents and purposes, the new tax laws are going to affect your 2018 tax return, correct? And so, what are some of the most important things about it? One thing you to really understand is that this tax law change only applies to your federal return. It only applies to your federal return. I have a lot of people telling me that, Karla, I don't need to gather X, Y, and Z for you because it's no longer deductible. But remember, this law only affects your 1040 return. None of the 50 states have conformed to the federal law. So that's going to be a lovely challenge for us tax people, right? But I think that I've seen this in the past. Believe it or not, I was around when they had the other major tax overhaul, Tax Reconciliation Act of 1986. I was new in the industry, just getting licensed, and it took the next 30 some odd years for them to get real clear on what the actual tax law meant. So what I will say to you, as although we've had a tax change and it has been a major overhaul, guidance will continue to be issued. Guidance will continue to be issued. So if your tax person alerts you that you need to amend your return, or perhaps they didn't do that calculation quite right, it's not exactly that they didn't know how. The guidance really is not there 100% across the board as to how things are going to apply. And you will see that as I go further along in the presentation. Make sense? All right, so let's talk about a few of the things that are going on. We had a government shutdown, right? For how many days was that government shutdown? 35 days. And I'm sure we all have some emotional issues over that. Personally, all right, 35 days, right? So what do you think has happened as a result of that when it comes to the tax world? Delays. We're going to have a lot of delays. We're going to have a lot of angry government workers, right? My best friend works for Internal Revenue Service, and she's one of the top agents. I pray for her every day, believe me. But she's telling me, Karla, the climate's not good. We're frustrated, we're irritated. So who is that going to impact? You. Taxpayers. It's going to impact the taxpayers. So what you can anticipate, even with the government now being open for 2 weeks or 3 weeks, I don't even know what they're doing at this point, is we can expect delays, right? We can expect angry and frustrated federal workers, probably a little bit of attitude when we call them. I heard on the news yesterday, if you mailed anything to IRS during the shutdown, that you need to mail it again, because chances are that mail is sitting somewhere and probably is not going to get processed. Your estimated tax payments, anybody who made estimated tax payments, the check probably cashed the bank, but probably did not get applied to your account yet, because that check goes to a lockbox in a bank, and then the IRS applies the payments later. So just giving you guys a heads up on what to kind of anticipate. The key takeaways are have patience, and definitely have patience with your tax person. Okay, that's for sure. Definitely have patience with them. We're in a lot of a turbulent time right now. So there's a lot of changes. So let's talk about some of the tax law changes that are going to impact you. Number one, we still have 7 tax brackets, although they have reduced the actual tax rate within the tax brackets. They took us down from 39% to 37% and gave us a lower rate of 10%. We no longer can write off the exemption deduction for yourself, your spouse, or your children. So for example, you're typically used to getting that $4,050 write-off for yourself. Your spouse, that would be $8,100, and a family of 4 would be $16,200. Are you guys familiar with what I'm speaking of? Yes. That's no longer a deduction for you. So you do not get the exemption deduction on your federal return any longer. Okay? Also, we have a higher child tax credit that went up to $2,000 for kids that are 17 and below, and we now have the new dependent care credit, which I think is important because a lot of us with longevity now are taking care of our parents, maybe aunts and things like that. So if they're on your return, you will get a $500 credit for a dependent other than your children on your tax return. So those are some things that have changed. The standard deduction for all intents and purposes has doubled. So those that were in the $6,000 range of standard That has gone to 12,000. Those who are in the 12,000 range of the standard now has gone to 24,000. Itemized deductions, they repealed the limitation on itemized deductions. So now if you're on your Schedule A, you get down to the bottom, there's no more limitation at the bottom. So your itemized deductions are now deductible at 100%. In addition to that, they now reverted back to medical expenses need to exceed 10% of your income. When I run for Congress, and I will, so remember, vote for Karla Dennis, I am going to make certain that medical expenses are straightaway deduction, because I think they really should be. The mortgage interest on non-investment property, so those of you who are sitting on investment property or rentals, commercial, residential rental, this does not apply to you. This mortgage interest cap applies to a primary residence or a secondary residence, meaning if you acquired a mortgage sometime in late December 2017, you only are allowed to deduct the interest up to $750,000. Now remember, this only applies as to the federal, not as to the state. The state still has the $1 million cap, $1 million of acquisition costs, and $100,000 of equity. Make sense to you guys? Okay, let's just remember it only applies to the federal. Your state and local tax, and this is going to be a big one. Your state and local tax, your real estate taxes, your DMV fees, your state income tax are now capped at $10,000. They're now capped at $10,000. So if your state property taxes, for example, on your residence may be $8,000, you only have $2,000 left to deduct in that category. You guys follow? So that's a cap right there. Also, the miscellaneous itemized deductions are no longer available. So unreimbursed employee expenses, tax prep fees, investment fees, union dues, safety deposit boxes, those are no longer deductible on the federal. This is really going to impact our first responders, our firefighters, our police officers, our nurses, because they get what you call meals on duty, because they have to work 24-hour shifts. That's a big tax deduction for a lot of them. They have to pay a substantial amount in union dues and a substantial amount of house dues as firefighters. So this is going to be an impact to those individuals. Those deductions are no longer deductible on your federal income tax return. And I want to continue to say federal because remember, it's still deductible in the state. The forms to reconcile the federal return to the state return are now 3 pages. It used to be 1 page. They have now expanded that to 3 pages, the reconciliation. So there's going to be a lot of turbulence. And a lot of people, I'm finding, are not really truly aware of how this is going to impact them. I think as a general consensus, most people know that there has been a tax law change, but most people really don't understand the drill down on their actual numbers. All right, so let's keep going. Business changes. This was a huge one. The corporate tax rate went from 35% down to 21%, and there was a repeal of the corporate alternative minimum tax. Not the individual alternative minimum tax, the corporate alternative minimum tax. And I think that's very interesting. Also, there's some special pass-through rules. But does anybody know why you think they dropped that corporate tax rate 14%? To get more corporations to come back to the United States? Any other reason? What was that? Who was brave enough to speak? Trump has a lot of friends. You know, I have to tell you, the people who champion the laws seem to get what they want out of them. Right? The people who champion the laws seem to get what they want out of them. So I like to dig and dig and dig and figure out who is behind a lot of these different laws. And a lot of the people who champion the laws, a lot of people who sit on the Ways and Means Committee, these people own businesses. So for that corporate tax rate to drop that substantial really makes me question why, right? Yes, we want to bring back businesses to the United States, but I don't know. You know, let's see what really happens. It will be interesting to see moving forward if the amount of revenue that they think is going to go back into the economy as a result of this will truly happen, right? That's how we really figured out. Okay, there's a special rule for pass-through income. So if you have a business, you are able to take advantage of Code Section 199A, and you want to write this down. Take advantage of Code Section 199A that says you get a 20% deduction from your business income. And I'm going to go into that a little bit later, but I have a question before I get there. How many people in here own a business? How many people in here own investment property? The same people that own investment property own a business. If you own investment property, you own a business. So there's only two types of earnings, right? It's all business income, and then there's earned income. So if you own investment property, you're classified as a business owner. You may not be an active business owner, you may be a passive business owner, but for all intents and purposes of the tax code, you are a business owner. And that's a very important distinction that you need to understand. You guys follow? All right, very good. You guys are like learning already. Check you out.
Questions?
I will take a question.
I was told that, these, property as an investment is not qualified for deduction as business.
And so you were told that properties as an investment are not qualified as deduction for business. And I am going to tell you that there is legislation that states that it is. It is. There's legislation that says if you have rental property, and this is going probably further than I want to, but I want you to be aware, and the takeaway is you do qualify if you have rental property, and you're going to have to prove that you put 250 hours, different from the 750 hours that you guys want to talk about, different from the 750 hours, you're going to have to prove that you put 250 active material participation hours in that rental property. Okay? And I'm going to get to that a little bit further in the presentation. But I do want you to know it is available. Okay? All right. So, I want you guys to be careful of some of the tax traps. So let me tell you some things that I know are going to come up and put you in a quandary, and you're going to wonder which way to go with it. So one thing that's going to come up is, number one, now that that $4,050 is no longer available for your dependents, right, on your tax return, should you still claim your dependents on your return? Anybody?
Yes.
Yes.
He said it depends.
Yes.
I like this gentleman. Depends on what? It depends on if there's a benefit, right? So one benefit to claiming your kids on your tax return or your dependents is you would get that $4,050. So we know that is gone. But what other things might you glean by doing that, right? So it's not just a black and white answer, yes, no. You really got to figure it out. So some of the other items to consider are medical purposes, college application purposes, whether you still qualify for the child tax credit, whether your kid qualifies for the dependent care credit. Now, where this is typically going to become an issue is what I call our in-between kids. Our kids that are 18, they think they're grown, but not so really, right? Those children may be off to college, maybe they're working part-time jobs, maybe they decide they want to file on their own. Mom, you don't get to claim me anymore. I can do my own thing. I'm being independent. But yet, they're still part of you when it comes to all of these other transactions. You follow me? So something you need to think about. And someone asked me, Karla, what if that kid files on their own for financial aid purposes if they're trying to go to college? Your kid can't be on their own unless they're 24. So they still have to ride on your tax return, or you still need to present your tax return for the whole FAFSA thing. So be aware, to this gentleman's point, It's not an exact right answer. You need to figure the best case scenario for you. Run the numbers and figure out, should you put your kid on your own, or is the kid better on your tax return? Very important to look at it from that perspective. Make sense to you guys? All right. The second thing, okay, let's talk about this 20% income deduction. So all of you that have residential rental property, you guys own a business. You may not want to be a business owner when the tenants call, right? But you all are business owners. You're classified.
What is the rule of that, so we can?
I'm gonna tell you the rules, so just hold on 1 second, please. You guys are all business owners. So under Code Section 199A, it says if you have flow-through income means income that is on your Schedule E as rental property, income that's on your single-member LLC, that could be on a Schedule C, a multi-member LLC that's going to flow through via a K1, a partnership, or an S corporation. Those are the classifications of flow-through income. Any income that is going to flow through to your personal income tax return, the law states that you will be able to take a 20% deduction from income. Now, I consider myself pretty good at math, and I would think 20% is 20%, right? So if we have $10,000, 20% of $10,000 is how much? $2,000, right? Well, not with this new funny math that they have going on. The booklet to explain the calculation for the 20% is about an inch thick. The booklet to explain the calculation on the 20% is about an inch thick. So, I want to give you guys some important takeaways. And I can't explain the full calculation because it's a whole thing. But this is what you need to know so that your awareness is up when you're talking to your own tax professionals. Number one is not just a 20% flat tax. That's the first thing, 20% deduction. There are some complex calculations that go into it. You are going to need to bring to your tax person a balance sheet. A balance sheet. A balance sheet shows your assets for your business. So if your business is rental property, it should show your cost basis for your rents, your rental property, building, land, right? Your loans, any loans or mortgages you may have out there. And if you're holding that business in an LLC, an entity, if you're in a formalized entity, you want to have a full balance sheet with money in the bank, whatever it needs to look like. It's important that you have that so your tax person can make the calculation correctly. If you took payroll last year in an entity, that would have been needed. If you were in an S Corp last year, you would have to have had payroll in order to qualify for this. You do not have to have payroll if you are a rental property owner. But some people have management companies and an S Corp. So I just want to bring this to your attention. The takeaway is not for you to know how to do the calculation. The takeaway is for you to know that there's a 20% deduction available to you. Bring it up to your tax professionals and know what you need in order to get it. Make sense to you guys? That's the takeaway, so that you don't leave that on the table. All right. Now, there's another trap that I want you to be aware of. SALT. That stands for state and local tax. State and local tax. And earlier I told you state and local tax was what? Property taxes, state income taxes, DMV fees. You guys with me? All right. So when it comes to the SALT deduction, and when you're in our industry, there's income tax, there's payroll tax, there's SALT tax. So I'm using the term that you will hear. It's called SALT, state and local tax. The thing that you want to be careful of, because there's a limit on that $10,000, you really want to choose your $10,000 bucket wisely. You want to choose what you put in your $10,000 bucket wisely. And why do I say that? If you get a refund in the state of California and you itemize your deductions, what happens the next year? Anybody? You get taxed again next year, right? you get that 1099-G form in the mail, and that form has to be reported on your federal return, that income, the following year. You guys with me? And that's because you deducted your state income tax. Okay, so now, follow what I'm going to tell you. So we have a bucket of $10,000 that we can use for our SALT deduction. In that bucket, you want to put your property taxes in the bucket first as a deduction. Put your property taxes in the bucket first. So let's walk a couple of scenarios. If your property taxes are $13,000 on your primary residence, your second home, your bucket only allows for $10,000, you're only going to put $10,000 of your property taxes in the bucket. Make sense? If your property taxes are $7,000, you're going to put your first $7,000 in the bucket, and then you would pull in your DMV fees next, and whatever's left, you put your state income tax in the bucket. Does that make sense to you guys? Okay, hold your questions. I'm going to go over it again. Okay, so that you guys understand. So, I'm using the word bucket just to say that's what we hold our state income tax. The bucket only fills up to so high, right? So our bucket only allows us to have a $10,000 limit. We can only put $10,000 of state and local tax in this bucket. You guys follow that part? We all have agreed that when we get a state refund in the state of California, we itemize our deductions. So in 2017, if you itemize your deductions, you got a state refund, you're going to get that 1099-G in the mail that says you have to report your state refund on your federal income taxes the next year. Are we familiar with that form? Yes. Okay. So now, as a result of that, we need to think about it. We do not want to artificially create taxable income for ourselves. We can avoid it. So what we want to do when we're looking at our taxes, and we have our property taxes, our state income tax, our DMV fees, and we got a bucket of only $10,000 that we could utilize, the first thing you're going to drop in your bucket, the first deduction you're going to take is your property taxes. Your first deduction you will take will be your property taxes. Are you guys following me? Okay, so let's use an analogy of we have $13,000 in property taxes, $5,000 in state income taxes, right? So we have a total of $18,000. We have a $10,000 bucket. What are we going to put in that $10,000 bucket? The $10,000 worth of property taxes. What's going to go on with the other deductions that we don't get? We don't know yet. Some people say it's going to be a carry forward. That's typically what they've done in other years under similar circumstances. However, I don't know that your property tax is ever going to drop. So is it ever going to really make sense to carry it forward to where? Right? So let's back up to our example and that analogy where we had $13,000 in property taxes, $5,000 in state income taxes. We all agreed, and our bucket is $10,000 worth of property taxes. All right, we all in agreement? Yep. Okay, let's go to another example. Let's say that we have $7,000 of property taxes and $5,000 of state income taxes. We're going to first put in what? The $7,000 of property taxes, and then we would pull in the $3,000 of state income tax. You guys with me?
What about the DMV?
Well, we would go DMV first. You're absolutely correct, but I just want to run an analogy with them. DMV, so your order is property taxes, DMV fees, and state taxes. But for all intents and purposes, I want you to understand, just don't randomly deduct your state income taxes. Because if you do, you're going to end up creating taxable income for yourself. You guys follow? Yeah. You're going to end up creating taxable income for yourself. And I will just say this, because I know there's a lot of confusion in this area. I do have my team at the back of the room. They will be able to answer your questions. We can get granular on your individual situation in a one-on-one, but not in an open forum, okay? Just know your takeaway is when I get ready to pull together my numbers for my state property taxes, my state income taxes, I know that there needs to be something done differently. That's your takeaway. bring your level of awareness up. Make sense? Okay, you may not know exactly how. How many of you in here are doing your own taxes? See me after class. Okay, the key is bring it up to your tax person. They may not understand that strategy. You with me? And those of you that are doing your own taxes, see me after class, seriously. All right, you guys get the takeaway here? We don't want to create artificial income if we don't need to. But we will if we blindly just deduct our state income tax. Yes, gentlemen in the back.
So you didn't go into, maybe it isn't important, what happens with the taxable income that you created. If you deducted 50% of your state tax, would you only create 50% of that refund income as taxable?
Correct.
Is it that sort of thing?
It is that sort of thing.
Okay.
That is exactly correct. And thank you for going to the next level. That's my next higher class, but you're right. But you're correct. So you get what I'm saying, right? If you do deduct some state income tax, there's going to be some type of proration to figure out how much of that is going to be taxable. The key would be to avoid it if we can, but we're never going to stop taking our deductions where we need them. Okay? And I'm a hold questions. We don't keep moving, but I will leave time for additional questions. Okay. So again, make certain to deduct your property taxes first, DMV fees next, and just be aware that you're going to create taxable income for yourself. Make sense to you guys so far? Okay. All right. The other trap, meals and entertainment. How many of you guys deduct meals on your tax return? Nobody? You guys don't eat? You guys are in business. Meals are deductible if you're traveling. So as real estate investors, you may think, well, how do I deduct meals when I'm a real estate investor? How does meals apply to my rental property, right? The key is if you're traveling more than 50 miles to get to your property, you're allowed to deduct traveling meals. So all of you, if the deduction is there and you're stopping and eating, you should take that deduction in your tax return. Entertainment is no longer deductible. How many of you in here truly have side businesses other than real estate? Other than real estate, okay, a few of you are braving your hand, right? Depends on what day it is, whether you want to own that business or not. We should not be deducting entertainment, and most times if we're entertaining, we're marketing anyway, right? So you need to drop your entertainment expenses into marketing or advertising. Most people are entertaining because they're garnering clients. That's the whole purpose. So let's make sure that we clean that category up. Entertainment is no longer deductible. Meals can still be deductible. Client meals can still be deductible. Travel meals are still deductible. And they're still deductible at 50%. Yes?
That's what I was going to say, isn't it 50%?
Still deductible at 50%. Absolutely. Okay, you guys with me on that? All right, very good. All right, so categorize your expenses correctly. Do not leave it open. If it looks or sounds like entertainment, what do you think is going to happen? IRS is going to question it. We don't want IRS to question our tax returns, right? We want to try to avoid questions. I don't know anybody that wants to get in a Q&A with the IRS, right? That's something we want to try to avoid at all costs. All right, so those are the things that you guys need to be aware of. So what do I usually see during a transition year like this, where there is a major tax overhaul, there's a government shutdown? What can we expect to see? And this is what I see as a tax professional, having been in the industry for a really long time, and I have other peers that are in this industry. We're going to see one or two people walk in our office. The type of taxpayers that are going to come in, we're either going to get the angry taxpayer that's mad at the government. I don't care, Karla. I'm taking all my deductions. I live in this country. I pay my property tax. I pay my state taxes. I want to deduct every single one of them. We're going to get those people, and we're going to refer them next door to the psychologist, who's next door to mine, and talk them off the ledge. And then we're going to get this person. We're going to get the real conservative person who is going to say, you know what, Karla, I don't want to take all my deductions. Yeah, I had that meal, but I don't want IRS to contact me They sent me a letter last year. I'm already on their special list. I don't even want to take all my deductions because I'm afraid of being audited. Is there anybody in here that's like that? Because I see head nods, right? People are afraid of the IRS. And that's natural to fear the IRS because the IRS is one of those agencies that you're pretty much guilty to prove an innocent, right? But I think that if we understand what we need to do, then some of that fear will dissipate. That's what I think. So my question for you is, what type of taxpayer should you be? In the middle? In the middle of what?
Informed. Informed.
Okay, so you said in the middle. You said take what?
Just try to take the deductions you're allowed.
Take the deductions you're allowed.
Informed.
Push the limit. This guy said push the limit. What else?
Informed.
Informed. Educated, right? You want to be an informed, educated taxpayer. How many of you in here want to follow the law? And the rest of you want to break the law? Because I'm against the law. We got a few criminals in this room. All right, I truly believe that the majority of taxpayers want to follow the law. That is my true belief. And I think that taxpayers get themselves in a slinky because they don't truly know what the law is. And then they start to Google, and Google, I don't know when Google became the Encyclopedia Britannica, but people Google stuff and think that that's the law too, right? And it's not the law. And then you call IRS, and you think you're calling to get the law, and that is the worst thing you could ever do. So what you really want to be is a taxpayer that follows the law, like the DMV rules, right? What do we do in a green light? What do we do in a red light? What do we do in a yellow light? Oh, I see. You guys are want to really follow the law, kind of, sort of, right? All right, so that's really the way that it truly works. There's a law. It's called the Internal Revenue Code, IRC, Internal Revenue Code, that you need to follow. So my philosophy is we're not going to be ultra aggressive. We're not going to be conservative. We're going to follow the law. Whatever that law is, as long as I'm following it, I am good. But the key is knowing what the law is. That's the key. So this is where I am going to educate you on the 4 steps you truly need to know to follow the code to get you to reduce your tax bill. The 4 steps you need to know to follow the code to reduce your tax bill. Are you guys ready for that? Yes. And it's only 4 steps. Really only 4. Okay. Step number 1. If you want to lower your tax bill, you have to have a business. How many people in here have a business? All right. If you have rental real estate, you have a business. And I don't say that lightly. Let me tell you why I say that. Because there's wage earners in the tax code, and then there's business owners. If you are a wage earner, your tax deductions are pretty much like a baby bathtub. You can only put a little bit of water in it, right? If you are a business owner, your tax deductions are like the Pacific Ocean. It's almost endless. So you really need to start thinking of yourselves as business owners. Yes, you're in the business of renting rental real estate, but at the end of the day, you are a business owner. And if audited, that's the code sections that you're going to come under. Make sense? All right. So as a business owner, you need to invest time in your business. You're here today. You're investing time in your business. You're getting educated. And you have some type of mentorship through Apartment Owners Association. They're guiding you. They give you guys classes. You guys can ask questions. I would definitely keep a journal. This is so important. You definitely want to keep a journal. And journals are for guys too. It's not for girls just to write down their emotions, right? Journals are for guys too. And when you journal, you want to journal about what's going on in your business. Today I went and I attended AOA's presentation, blah, 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 blah. That's very important. Why is that important? Anybody? Show what? Who said that? Show you have a business. participating in business because business owners participate in their business. They mind their business. So this shows that you are minding your business. Does that make sense? Yep. All right, so that's the very first thing. And I am certain that with your real estate, that you guys have some type of plan or strategy around it. At the very least, you plan to get your rents every month, right? At the very least, okay. So step one, you must have a business. Step two, your business expenses must have a purpose. What do I mean by that? Your business expenses must have a purpose. So I am going to pick on this gentleman because he's right here in front of me. Can I pick on you? Okay, what is your name? Steve. So Steve, you have rental property, and I call you up, and I tell you that the sink is stopped up. What are you going to do? So you're going to call the plumber to go out and clean the drain. Why? So you don't have to do it? Okay. All right. What's the other reason you're calling the plumber?
Profession.
So you're required by law? It's a business write-off? You serve your customers?
Liability.
Liability? What else?
Get the receipt.
Paper trail? It's a human thing to do? Okay?
Part of business.
Part of running your business? And prove to the IRS you're doing your job, right? But ultimately, do you want to fix that plumbing because of all of those things? Or do you want to fix that plumbing because you really want to protect your investment so you get your rents? Right? That's ultimately the reason why we're doing it. Because we want to protect our investment, and we want to get our rents, and we want to get our rents fast. So if they call us around the 28th, 29th of the month, we're going to move quick because the rent's due on the 1st, right? Exactly. So you are truly spending those expenses because you want to protect your investment. I don't know any of us that are going out spending money on repairs or insurance just for the sake of it, right? Do we do that? No. We're doing that to protect our investment. Our investment is in our rental property because our rental property returns us what? Income and hopefully some appreciation, right? So we got to protect our investment. So when I say your business expense must have a business purpose, it must have a business purpose to link you to the pursuit of income. That is a term I want you to write down. To link you to the pursuit of income. Now, you said, Steve, that you could have went and fixed it yourself. So I'm an IRS agent. I'm like, well, why would you waste money? Like, if you could do it yourself, why would you go pay a plumber? Because they could do it more efficiently, right? Got it, okay? And who decided it was more efficient? Your wife? Are you wife? I like the wife. Get your butt home and call the plumber. That's right. That's what I tell my husband. Oh my God, the plumber could have finished in an hour. You've been there about 5 hours. Exactly. That's exactly it. You're right. So, but you decided it was the most efficient method to handle it. Is that written in the tax code anywhere? That the most efficient method to handle a plumbing issue is to call a plumber? No. So I want to tell you guys a story. This is a true story of one of a client that came to me. And this client was a real estate agent. She also owned investment property. She sold beachfront property like in Dana Point, Newport, Huntington, and she was doing really well. And she decided to go out and buy a yacht. Does anybody know how much a yacht costs? A lot, right? So a yacht is a lot. She decided to go and buy a yacht. And she took it a step further and decided to deduct that yacht on her tax return. She deducted the yacht on her tax return. And IRS has this funny way that when you take a tax deduction 1 year, you think you're safe. And then you get it the next year and you think you're safe. And then they come to you in the 3rd year, right? So they came to her in the 3rd year and they audited her and they disallowed her yacht. And so by the time she had gotten to me, she had gone through her tax person, hired another tax person, and she came to me with a letter from the IRS, a 30-day letter, saying she owed back $256,000. Right? And when she came with a little bit of attitude. I don't know what you're going to be able to do for me, Karla. I'm like, I don't either, but we're going to figure it out. But I understand why she came with a little bit of attitude. $256,000 is nothing to sneeze at. She thought she was doing the right thing. Her tax person put it on her tax return, thinking that she should be able to deduct it. It's one thing to put something on a tax return. Thinking you can deduct it is something else for it to stand up against an audit. Just because it flies the first time doesn't mean it can stand up against an audit. So when she came to me, my job was to really understand her situation, understand why she thought that was a tax deduction, understand her business model. And her business model was such that she would take people out on her yacht to look at these beachfront properties, right? And back up to the bay. So then I asked her, I said, well, did anybody on your list of people that came on your yacht, because there's a captain on the yacht, and they keep a list of everybody that comes on it, did any of these people buy from you? And she said, no. Did any of their friends, did anybody refer you business? She goes, yes. I'm like, okay, so you did get some referrals from this, and we were able to link it to the pursuit of income. So when I went back to the auditor, and I said, auditor, Mr. Chu was the auditor, I'll never forget, and he'll probably never forget me either, and I hope I never see him again. I went back to Mr. Chu, and I said, Mr. Chu, her business, is this ordinary and necessary for her to take this deduction? And she has a referral of a client from another client who purchased from her. So I feel like this tax deduction is ordinary and necessary. Mr. Chu said, how do you determine if it's ordinary and necessary? I said, Code Section 162 states, you can take any deduction that's ordinary and necessary for you to do business as long as you're in the pursuit of income. In the pursuit of income. It didn't say you had to make income. It said in the pursuit of income. That was under Code Section 162. So we were able to get that yacht as a tax deduction for her. Zeroed out that tax liability for 3 years. The key is, who decides what's ordinary and necessary? In your case, it's your wife. But for the rest of you decide what's ordinary and necessary for you to do business. IRS does not get to decide that. Your key is, you've got to link it back to the pursuit of income. That's the key. You decide what's ordinary and necessary under Code Section 162, and you have to link it back to the pursuit of income. Does that make sense? Very important that you know that, and that you don't allow IRS to tell you what's ordinary and necessary for you. Got it? All right, so what's step number 2? Your business expenses must have a purpose. What was step number 1? You're paying attention. You're probably going to get out of here on time. Must have a business. All right, step number 3. You got to have proof of payments. Does anybody know what proof of payments is? Receipts. Right? Is a check proof of payment?
Yes.
No. No. A check is a method of payment. A method of payment. Check, credit card, cash receipt is a method of payment. Proof, a canceled check is a method of payment. Proof of payment is a receipt with method of payment. Proof of payment is a receipt with method of payment. So you're probably saying, Karla, are you serious? We got to actually keep those receipts? Yes, I'm serious. You know the kind that fade? Those receipts, you need to keep those receipts. So now the question becomes, how many of you guys have an accounting system or somewhere that you're tracking your stuff in some type of accounting system? Anybody in here? Okay, a few of you. Anybody in here have a smartphone? And the rest of your phones are dumb? Like, what is happening to this room, right? All of you guys in this room have a smartphone. I'm almost willing to guarantee it. If you have a smartphone, you have in your hand a little accounting program. There's so many apps that are available in the App Store that you can download that will allow you to take pictures of your receipts and keep track of them. So I'm gonna give you a strategy that you can employ. Adopt a millennial. If you don't have one, adopt one. Befriend one. Because those young kids can figure out everything as it comes to technology. I have 4 sons and I have a 16-year-old. And my 16-year-old, if I come home and I say, Carrington, something's going wrong with mom's phone, he goes, Mom, you're getting old. I'm like, child, I don't care what it is, fix it for me. He can fix it. The computer, he can fix it faster than the Geek Squad people, right? So if you have a millennial in your life, have them download you something simple so you can start to track your receipts. Do you take pictures on your phone? All of us take pictures on our phones, right? And we never develop them. Like we used to. Remember back in the day, your guys' day, not my day, you guys used to have photo albums?
Yes.
We don't do photo albums anymore, right? I know. Put them all in the cloud. And do we ever go to the cloud to get the pictures? I think we should all go back to photo albums. I love photo albums. Bottom line is, we need to get some type of app on our phone so that when we're out and about, we can just take a picture of those receipts. And at some point, download it, right? At some point. But you want to track your receipts, and I'm going to take the lady far back.
I just have a question. When you're saying receipts, so the tenants pay their rent with checks.
Yep.
And I don't give them back receipts.
And that's fine because that's income.
Okay.
Income comes under Code Section 61. So
Okay,
income could be, income is income from any source derived.
Okay,
So
so
if
you're
you go find $10 in the street, that's income. So you have to disprove income and approve expenses.
Okay, so
Okay.
the receipts are expenses.
Correct.
Okay.
You want to have receipts for expenses, absolutely.
Okay.
And I'm going to take one more question over here.
Doesn't everybody get a receipt when you get an invoice? I don't pay for it.
Not always, and let me tell you why. Because you know what has happened with the whole technology thing? We may go online and buy something, the receipt goes in our email, right? And we never actually pull the receipt down. Or if you're married to like my husband, between our house and Home Depot, which is only about 2 miles, some kind of way he loses the receipt. It's like magic, flies out the window, honestly. So there's not always a receipt, but here's why I'm telling you this. If I want to be able to say to IRS, my clients are following the law, and they're taking their deductions under Code Section 162, and these deductions are ordinary and necessary, when I come over here to support those deductions, I want my clients to have both things. I want the cancel check, and I want the receipt. Now, could I push the envelope and probably get away with not having a receipt? Yes, but if I'm telling IRS that you are a compliant taxpayer, that you follow the law, that everything over here is tax deductible, but over here he doesn't really keep his receipts, and he only pays by cash, and I don't know where the cash comes from, and it's all under the table. See what I mean? Like, we gotta be either compliant or not compliant. Either we gonna speed up on the yellow light or we gonna stop. We just have to make a decision. And if you guys wanna follow the law, reduce your tax bill, the decision has to be that you follow it all the way. Right? Make sense?
Yes.
Okay. Just so that we can always argue in our favor. Now, have I dealt with cases where a client didn't have one receipt? Absolutely. I have represented clients that haven't had any receipts, and I've been able to get those deductions. But that's not what I want for you, because we don't need to go there, right? We want to keep the auditors happy. We want to be able to get our deductions. We want to keep them nice and friendly and the whole 9 yards. All right? So, third thing is proof of payments. Yes?
Are bank statements and credit card statements considered receipts?
No. Bank statements and credit card statements, like you get that year-end Amex summary and Capital One things like that, that would be considered almost like a method of payment. So let's say, for example, if you have a bank statement that has the images on it, your check images, you could use that as a method of payment, but that's not a receipt. The receipt is the actual physical paper that supports whatever it is that you purchased.
Okay, that's good.
Very oftentimes it says who it is you've done the credit card payments on.
I'm on your side. I get it. I get it 100%. I know. But I am just telling you what's required. 100%, then we just want to do what's right. Now, with that being said, can you possibly get an audit and get away with not having your receipts? Possibly. But if I'm trying to get that yacht deducted and that IRS agent is already kind of like not happy, they're going to nitpick us, right? So my thing is, and my philosophy is, let's just have what we need. Let's just follow the law. Like, it's real simple. It says I'm supposed to do this, I just want to do that. Okay? All right. Third thing, proof of payment. You guys with me? I'll take your question.
Like on an SDG&E, you don't get a receipt, but on the statement it shows that they received or applied
Yep.
that you paid.
So that is a receipt. That's on the electric bill, correct? Yes. That's different. Your electric bill are your statements that say the next month, receipt payment, or behind a bunch of, whatever that needs to look like. But to your point, that's correct. All right. So third thing, proof of payment. Okay. Fourth thing, expenses need to be properly reported. Put in the right categories. Put in the right categories. So one thing I see frequently is I will see the category of repairs. And repairs have a tendency to be lumped together. We want to minimize the need for IRS to ask questions. So your repairs should be broken down into like plumbing repairs, electrical repairs, door repair, sink repair. And the reason why I tell you that is because the smaller the category, the less likely of an audit. Now, some of you are going to say to me, Karla, what if we have a handyman and he comes over and he fixes a bunch of things and he just gives us a receipt for one thing, right? In situations like that, depending on the size of the receipt, and I'm usually, my threshold for IRS not to question is about $2,500. That's my threshold. Anything going above $2,500, they're going to question that expense, especially ask for repair or rental property, because they're looking to see if that should be something that should be depreciated, right? Capitalized. So we can get away with about $2,500 in repairs before they're going to drill down on it. If you have a handyman that's fixing things, I would just allocate what he fixed. And I would use comparable charges. So if I had to hire somebody to do it, I would take a reasonable amount. So if my handyman bill is $500 and he came in, $5,000, maybe he came in and repaired the toilet and the windows, or whatever case may be, I would just allocate some stuff to the windows and things like that. At the end of the day, is it going to be 100%? No, but is the cost and what you paid 100% in the aggregate? Yes, right? So we're not going to worry about that piece of it. Does that make sense? One other thing I see on tax returns are office expense. Can anybody tell me what office expense is? What is office expense? It's your computer, it's cell phone, paper, internet, software. You see the problem? We all got a different answer. We all got a different answer for office expense. So instead of us having office expense, why don't we have internet expense? Why don't we have office supplies? Why don't we have equipment? And so that the categories become smaller instead of office expense. Because every time I represent a client in an audit, office expense, miscellaneous deductions are always audited. They're going to hit those categories all the time. Now, the reason why we have a lot of audit experience in our office, not because our clients get audited, we may get a random audit maybe once a year, but we represent for other CPAs and accountants who don't represent their clients in audits. They'll hire me, my firm, and we'll represent them. So I'm a statistical person, and I love to keep track of data, why things happen. On this type of return, was miscellaneous deductions audited? And I track it. It is audited 100% of the time. Miscellaneous deductions, office expense, 100% of the time. Repairs, pretty much 100% of the time. Please do not put on your tax return Home Depot. Do not put that. Lowe's. Amazon needs to go away. Amazon probably is going away now that they're getting a divorce, right? They might just go away. We want to make sure that those categories are categories that we can easily explain. If IRS is looking at it, we don't want them to have to think. If they flag my return, when it goes in electronically, and if they pull it, they look at it, I want every question they might be able to ask me already answered, right? We want to keep it real simple. We don't want to use terms that IRS does not understand, right? They're not in our industry. Let's not use terms they don't understand. So like, I wouldn't put AOA, right? What is that? They don't know what that is. So I would definitely put Apartment Owners Association dues or whatever the case may be, but I wouldn't put AOA because it's not clear to them. It's not that it's not deductible, but you want it to be clear so they don't want to ask you questions. How many of you want IRS to ask you questions? Okay, so we're all in agreement that we want to avoid that, right? They're not that bad. You know what's so funny? My girlfriend who works for service, she's about 100 pounds wet. Honestly, it cracks me up. And her role in the service is she shuts down, she works for CID, Criminal Investigation Division, and she shuts down tax preparer offices who do illegal stuff. Yeah, it's really interesting, and they always do it on April 15th. Always. They go in their offices and they roll out the file cabinets and the computers on April 15th. And why do you guys think they do it on April 15th? Because it's the most time, all the returns are done, right? Can you imagine the taxpayers, right? It's happened several times in Orange County. Google it. Just Google it. You'll see what I'm talking about. They go in those offices, shut them down, bring their badges out, take all the files, and every client in there is going to get audited. Yeah, that's her job. That's why we're best friends, so she will never come to my office. All right, so step 4, expenses have to be properly reported, right? Okay, so I gave you guys 4 steps. You must have a business, step 1. Step 2, your business expenses must have a purpose linked to the pursuit of income. Step 3, you gotta have proof of payments. And step 4, expenses must be properly reported. Got it? Is that difficult? It's not that difficult, right? But I gave you a code section that I said was important for you to remember. What code section was that? 162. Remember that. And when you tell that to the IRS, they'll look at you like, what? But you need to know. You also need to know Publication 1. Publication 1 is Taxpayers' Bill of Rights. So if you're ever contacted by IRS, Publication 1 is like Miranda rights. You need to know your Taxpayer Bill of Rights. That's very important. You have the right to remain silent if IRS knocks on your door. You have the right to representation. Because some of you, when IRS knocks on your door, it's kind of like confession. You just start talking, and you do not have to talk. You do have the right to representation. And I think that's important for everybody to know, because sometimes IRS will probe you and you will enthusiastically go down the wrong path. And then I'll hear, Karla, but they were so friendly in the beginning. Yeah. They're trained to be like that. So just be very careful. All right, you guys with me so far? All right, so the most common nuances I see is not keeping good records. Yes?
What publication was that?
It wasn't a publication. Oh, Publication 1, Taxpayer Bill of Rights. I do. See the back table before you leave, and they will give that to you. Yeah. Okay. The most common nuances I see is poor record keeping muddled, commingled, disorganized records, operating out of a shoebox, a paper bag, having one bank account for your personal stuff, one bank account commingled in with your rental properties. I am going to tell you, get yourselves organized and do not do that. You may have 2 personal accounts. One account for all your rental income, if you choose to operate it that way, and then a separate account for your personal expenses. Separate it out. Why do I tell you to do that? Because if you're ever audited, we want to have a clean trail. What's in this account is business expenses, and what's in this account is personal expenses. If it's commingled, then we cannot justify which is which, right? So let's not commingle it. Very important that you separate that out. We have started at the beginning of 2019. start 2019 off correctly. I remember I had a client come in my office, gentlemen, and asked, he wanted us to do his taxes, and he owned a grocery store, and I said to him, okay, well, do you have like some financial statements, a profit and loss, a balance sheet? And he goes, do you have a dolly? A dolly? I go, a dolly for what? He goes, oh, I have 12 boxes in the back of my truck of receipts. The key is, you guys should really, really, really track your stuff. Because honestly, in our industry, we talk about the clients that are the most organized are going to get the best from their tax person. You're going to get the best because we're not going to have to spend time getting you organized. And if you're not organized, we do have a solution for that because we have an accounting department that can get you organized. But when you come in with your tax person and you're organized, we can really help you more so. So there is a little thing in the tax industry, us tax people say, that if you're walking in to a brand new tax person to get your taxes done and you haven't tried to talk to them and build any type of relationship with them, when you're walking in, like from January 15 to about February 15, you're walking in the emergency room on your own and you're checking yourself in. About February 15, March 15, you're coming in on a gurney, right, or a wheelchair. March 15th to April 15th, you are on a gurney. April 15th and after, you're on a gurney and they're shocking you back to life. The key is, you guys want to get a relationship with somebody that understands your tax situation. It's not just about the pieces of paper. And you're going to understand why I say that in just a moment. So now, I'm really going to teach you what I learned at the law firm. And can anybody tell me why the wealthy stay wealthy? Wow. They read the tax code? They write, ooh, I like you, what's your name? They write the tax code, right? What else? What else do they do?
They hire professionals.
They hire the right people. They don't pay taxes. Now, when they say they don't pay taxes, are they doing that legally or illegally? And before you answer, I'm going to answer. My gut is the majority of them are doing it legally. They're not doing it illegally. They're doing it legally. Because you can best believe IRS is on those tax returns. And they are reviewing those tax returns. But they're doing it legally, and they're using the tax code to do it. So my philosophy is, I believe that taxpayers should pay their fair share tax using the tax code, but I do not believe we should leave Uncle Sam a tip. When you go out to dinner, and you get that receipt, do you write in that tip? Or do they write in the tip?
You do.
Right, well, yeah, you're right. It depends on the restaurant. They will tip you. But for the most part, you know how much the tip is, right? So if you're going to leave Uncle Sam a tip, you should know how much it is. Do you agree with that?
Yes.
All right. So I am going to teach you why these companies, the owners of these companies, individuals like you, really do not pay any tax. And if they pay taxes little, it's a little amount relative to their income. Everything's relative. They pay a small amount relative to their income. And this is truly what I learned at the law firm. All right, so the wealthy people stay wealthy because they're organized and they put together a strategic plan. Most of us have been taught to gather our tax stuff, take it to our tax person, and file our tax returns. Is that a true statement? Right? None of us, for the most part, have been taught to really strategically plan to reduce our tax bill, because we're not taught that part of it. So I am going to teach you what that truly looks like. So the very first thing that you have to do in order to keep more cash in your pocket is strategically plan and get yourselves organized. That is what's going to be required. You have to plan it out. The very first thing is there are 6 prongs to a strategic tax plan. I'm going to walk you through them. Get organized. That's number 1. You got to get organized. And here's what I'm going to say about organization. If you're not organized, it's okay. The time is now, right? We're not going to cry over spilled milk, but I will give you a strategy for getting yourself organized. If you are not organized for 2018, use what I call 12 by 12. Take 12 days, gather the first day, your January 2018 bank statements, your January 2018 calendars, credit card statements, and get yourself organized. Take 1 day, 1 month, 1 day, 1 month. The reason why I said to look at your calendars is because a lot of times your calendars tell you what you've done in the past. It gives you insight that maybe you've forgotten about certain things. So if you would at least go back to your calendars, it will pique your memory and help you to remember the things that may be tax deductible for you. Make sense? So take 12 days, get yourselves organized. Okay, the very first thing that I do in strategic planning when I want to help reduce a client's tax bill is I want to review their past year's tax returns. And I'm going to ask for 3 years worth of past tax returns. Does anybody know why I'm going to request 3 years? What did you say? See trends. What else? What was that? To see if IRS has audited you? Take 3 years from IRS audit? Got it. Well, that's a statute. Anybody else?
Sometimes you have an unusually large expense one year that you might not have.
Yeah, right? You may have an unusually large expense. So what I'm doing, I want to go back 3 years. Number one, I want to understand what you've done in your tax return for the last 3 years. So I can read a tax return like a doctor can read x-rays. It tells me a lot about an individual when I'm able to read their tax return. It's kind of like my lab work, if you will. If I can see your tax return, it really does give me windows into your financial picture, but also what I'm looking for is opportunities. I'm looking for opportunities on things that could have been done differently to parlay you into a better position. Not things that were done incorrectly, but things could have been done differently. And I like to use that word because a lot of times people will say to me, well, Karla, my tax person did it wrong. No, not necessarily did it wrong, it just could have been done different. And the best analogy I could give you is like cupcakes. Who in here like cupcakes? Anybody like cupcakes? The rest of you guys don't like cupcakes, really? Okay, so a vanilla cupcake is a cupcake, right? But a vanilla cupcake, that's a real big cupcake, that's salted caramel, and has caramel on top, and some peanuts, right? It's nice and hot with a cup of coffee. It's still a cupcake. That's a better cupcake in my opinion, right? So bottom line is, it's not to say the tax return wasn't put together correctly. It probably was, but there's usually some things on the tax return that I could have done differently that would have put you in a better position, right? So I need that history. So I'm gonna walk you guys through a story, and this personally happened to me. One tax year, I was suffering from migraine headaches heavily, really bad migraines. And I went to the doctor, and I said to the doctor, I have migraine headaches, and she's asking me all of these questions. And I'm pretty much like this, I get to the chase very quickly. And she says, Karla, if you want my help, then you need to be patient and let me do my job because I'm the doctor. I'm like, ooh, okay, right? So she took me all through my past history. She asked me a bazillion questions. Have I ever had headaches before? Have I ever had high blood pressure? Like she went down this whole litany list. So I had to take a pause and say, okay, I'm really here for some help, so let me respect her process. So she went through all of my history. The very next thing she did was she assessed my current situation. She said, okay, Karla, we're gonna run some lab work. We're gonna take some blood, some urine, we're gonna get your blood pressure, your weight, we're gonna get your current situation. Why do you think she was doing that? What? Comparison? What else?
Establish baseline.
A baseline. Who said baseline? To get a baseline. She wanted to get a baseline of where I was at that moment, right? Very important. So I would do the same thing. If I am going to strategically reduce your tax bill, what I need to do is assess your current situation. What does your 2018 tax liability look like right now? And what are we looking like for 2019? And some of you may say, Karla, we haven't even closed the first month of 2019. You're correct, but I could probably project out where we're going to land, right? based off trends, based off history. I can tell you pretty much where your 2019 tax bill is going to be. And I'll be pretty close to it, barring something major happening. So it's important that I get that baseline to see where you are. Good, bad, and different, we at least are going to know what we're starting with. Does that make sense? All right, so once we did that, she reviewed my past, she got my baseline, all my lab results. She called me back in her office, and she said, Karla, okay, you're having these really bad migraine headaches, you're getting nauseated, you're a tax professional, I could give you some medication that will put you to sleep. And I'm like, oh, that's useful. Let me do tax return sleep, right? I don't know. Karla doesn't do pills. I don't like that. I want a solution, not a Band-Aid. She says, okay, well, I really need to understand your entire situation. I need you to keep a diary of what you eat. I need to know your work life, your home life. Like, I want to know your entire situation. And she really started digging deep. She was like, okay, you have 4 boys. Are your 4 boys stressing you out? I go, no, they're not stressing me out because I would just put them out. So we can get that very easily, right? And what about your husband? I go, nope, my husband still loves me. It's cheaper to keep her at this point, so he's not going anywhere. And she said, okay, well, then you need to keep a diary of everything you do, everything you write down. I said, okay, got it. So when it comes to this part for you, I got to understand what it is you're trying to accomplish. What is your vision? You may say to me, Karla, my goal is to reduce my taxes. I get that part. I know you want to lower your taxes, but the way that I lower your taxes, because there's over 80,000 pages of tax code, is going to be predicated upon what you're trying to accomplish. And when I say what you're trying to accomplish, what I mean by that is some of you may be trying to purchase more property where you need to qualify off of your tax returns, right? You need to be bankable. Some of you may be trying to sell a piece of property and exit the real estate game. Some of you may be trying to level up to another property. Some of you may be going through a divorce. Some of you may have aging parents. Some of you may have kids that are going off to college, or kids that won't get out of the house and they've already been to college, right? It doesn't matter what the situation is. The key is I got to understand it. Because if I lower your taxes for a short-term gain, come April 15th, you don't have to write a check, you're happy. But maybe 3 months from now, when you're trying to really accomplish your bigger goal, maybe I lowered your taxes in a method that's not going to get you to where you need to go. Does that make sense? For example, I get that a lot when I'll talk to clients and then they don't tell me the whole story, and then they'll call me and say, Karla, my lender says I'm not bankable. Well, yeah, because we really lowered your taxes. However, we could still lower that income and make you bankable if I know you're trying to purchase more property. So it's really important that I understand exactly what you're trying to do as best as I can understand it right now, right? Because things change. So I told the doctor, I said, no, I gotta be in charge of me. I can't be on medication that's gonna knock me out, right? I don't be oozy or whatever you call it, loopy. I need to really understand what's going on. I review tax returns. I want to be clear. So she went through my diary that I kept. And long story short, what we discovered was I would burn in my office every single day these peppermint candles. And the peppermint candles were triggering my migraine headaches. And when the headaches would start, I would burn 2 candles, right? Just making it worse. Not even knowing something that simple and granular was the issue. Now I burn lavender linen. They smell so good. I love lavender linen candles. Bottom line was she took the time, I respected her process, and she figured out what was causing my problem. You guys follow me? Yeah. So the key is we can implement the right strategies to drop your taxes. That's going to be the easy part. The hard part is making sure we lower your taxes according to your goals and your vision, according to your objectives and what you want to do for the long haul. That's the key. And also having the patience to walk through the process and allowing us to do it. Does that make sense to you guys? Not the strategies that you Google, right? Because I get that all the time. Clients come in with these printouts from Google. Karla, I need you to read this. You know, because Google is exactly the truth. It's authority all the time, right? They'll bring me Google. They'll tell me what their friends are doing, what their neighbors are doing, what their sisters are doing, what their brothers are doing. Their brother, the engineer, is also their accountant, right? My brother's an engineer. He's funny. He's a civil engineer, and he does his taxes every year by himself, and then he brings it to me to review. It just cracks me up. Anyway, gotta implement the right strategies for you. Not your neighbors, but for you. Not according to Google, but for you. Then, once we implement the right strategies, what's important? Once I left that doctor's office, what do you think was important?
Get rid of mine.
What? Action. Follow up. Karla, how's it going? You haven't been back in here yet. It's tax season. I don't care. Get back in here. We need to do some more lab work. I want to make sure. You've got to continue the conversation. So what I like to do is follow up and touch base with clients about every 80 to 90 days because things change. You guys have a tendency to go out there and do tricks. It's all good stuff. But the key is if we put together a strategy to reduce your taxes, and if you purchase another building, sell a building, something happens, that I want to sharpen my numbers to make certain what I tell you is going to happen on your return is going to actually happen on your return. Does that make sense? And tax planning is completely different from tax preparation. Completely different. Tax planning is literally the structuring of the house, and maybe tax preparation is painting of the one room of the house. It's a totally different animal, and they're two distinct things. And I think what ends up happening is clients think that when they go to a tax person, that their tax person is supposed to also be able to reduce their tax bill during a tax preparation appointment. And that's not what happens, because it's called tax compliance at that time. Does that make sense to you guys? All right, so I said to you guys that I was going to tell you guys 3 things. Number 1, I said that I was going to tell you about the tax law changes and how they affected you. Did I tell you that? Number 2, I told you guys that I was going to tell you how to follow the code, and I was going to give you those 4 simple steps. Did you get those steps?
Yes.
And number 3, I told you I was going to tell you how to reduce your tax bill. What's required to do that? Did I tell you that?
Yes.
All right, so I told you my 3 things. All right, excellent. So now I'm going to tell you 2 more things, and then I'm going to open up for questions. Number 1 is, if you are interested in my team having a conversation with you regarding your situation, at the back of the table, my team has these 30-minute consultation cards. You can fill them out. They will have a conversation with you, open up an online portal. You will load your tax return securely. You're more than welcome to drive down to our office. We have beautiful offices. Most of our work is done by the phone or by video. The next question is, Karla, are you going to be the one that does our 30-minute consultation? The answer to that is no. Karla will not do your 30-minute consultation because I train my staff on how to look at your return and bring you value. Where I get involved in the planning is when we're trying to roll out the strategies, then we come together as a brain trust, and then but trust me when I tell you, I am not the smartest person in my office. And I am not. I have other licensed tax professionals that hold masters in tax and accountancy, and we all get together like a brain trust to figure it out. Because at the end of the day, you guys deserve the best. I may be thinking one way, they may be thinking another way, but in the aggregate, trust me, we're going to get it done. So I want you guys to depend on the process and not the person. You guys understand that piece? All right. Outside of that, I am going to open it up for questions. Let's see. I have about 15 minutes, and I can open up for questions, and I'll take this gentleman over here.
Can you talk about expenses derived from non-1099able contracts?
Can I talk about expenses derived from non-1099 contractors? Explain a little bit more.
I hire a Mexican to lay concrete for me.
Okay?
You give me a American chair.
Okay? All right, so I got it. So your question is, if you hire somebody that you are not 1099ing, because I don't